Your perspective right now on the regulatory repercussions of what's happening with Credit Suisse in Europe and Switzerland, but also what happened with SVB here in the US?
Yeah, look, since the Fed began tightening financial conditions about a year ago, I think in the Valley, at least in the private markets, many companies have began to readjust their operating plans. And for those that haven't, I think what happened in the last week is sort of a wake-up call. So I think by now, almost I would argue most of the companies in the private markets are now preparing for a slowdown in the markets and the economy. So now I think in the short term, many founders, the one I've seen in our portfolio in their network, have been opening new accounts, getting new access to line of credit, extending cash runway, and cutting cost. But I think in the long term, it remains to be seen what the ramifications are. But I have a few theses. I think one is that there's definitely going to be new regulatory actions coming from the Fed, the Treasury, to further tighten bank operations.
Yeah.
I think for fintech liquidity, I would say this year will be a test of what companies are going to survive at this point in the business cycle. And in my view, the ones that will survive will come out fine. And I think at least in our conversation with founders, most founders are on top of what's going on.
Joe, you say that there was this sudden need to diversify where your money is kept. When I'm talking to founders, when I'm talking to VCs, they're saying the issue is it's not as easy for a founder of a company to walk into JP Morgan and say, hey, I used to bank with Silicon Valley Bank. I need to put some of my funds into you. They have too higher thresholds. How difficult is it to diversify in terms of where you put your money, whether it's at Credit Suisse and looking outside of there, or whether it's Silicon Valley Bank?
It's a great point. So across our portfolio, we've run an analysis. The larger unicorns, the one that have $50 million or more in cash, they've been banking with JP Morgan, HSBC, and the like, and Citibank even before SVB's incident. The smaller companies, the pre-seed, the Series A, the Series Bs, they've been banking with SVB, which tend to have and the like, which tend to have kind of a lower threshold for minimum assets. So the later stage companies, actually weren't as exposed to SVB versus the earlier stage companies. But a lot of the earlier stage companies, have been trying to open accounts. Now, to your point, it is not easy to open an account with JP Morgan, some of the larger banks, which have a higher sort of a threshold. And so as a result, you're seeing some of the earlier stage companies going to B of A, First Republic, and even Brex.
But Ed, you've been reporting day in, day out, not only the impact on the startups, but the venture funds themselves.
Well, as Joe knows, if you're a firm with sizable funds, you've got more than one bank account per fund, you've got an operating cash flow fund, you've got de-risk or side bank accounts for side initiatives and funds. And Joe, what we've been talking about all show long are tighter financial conditions. How does that impact venture firms and their ability to move?
Yeah, so we've seen this as early as a year ago, even a little longer than a year ago, where you have a few channels of the Fed's kind of transmission mechanism hitting the real economy in the last year or so. One is that LPs, limited partners, investors in VC and PE funds, they've been allocating way more into fixed income at the expense of equities, just because it's a higher guaranteed rate of return, assuming that there's low risk. And so the second thing is that I think the decrease in valuations and market prices have also hurt some of the kind of the return profiles. So I think the last thing is this is sort of most LPs, like pension funds, have like a budget for what goes into equity, fixed income, real estate, et cetera. So because venture and tech have been outperforming in the last 10 years, that they've gone over that budget. So even sans the recent market correction, they were pulling back on allocated to equity. So with what's happening last year, they've cut back. So LP capital in VC funds have slowed down, which is why you're seeing a slowing funding. Last week, some of the VC funds that had their funds tied up at Silicon Valley Bank, they would even have trouble funding startups because their own funds were tied up in SVB. So it's been a really interesting year for investors.